Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Another crazy week, probably another one for the record books. So let's get straight into it. Giles, I'm going to start with you, although really we could start anywhere this week because we've all been very busy, but we've had a pretty dramatic move in bunds this week. I think 10-year bunds probably on the week are now down about 40 basis points. We're recording this on Thursday afternoon for anyone who's kind of fact checking me. What has really changed, and is that the right move? What's really going on here?
It has just been the most absurd week of volatility since the last absurd week of volatility, and that 40 basis point move that you just mentioned, let's see whether it'll be more or less by the end of the week, but that was just 2 days, 25 basis points of which came today on the basis of a slight disappointment on the PMIs. So what is going on? I guess we'll come to the way it all started actually with you in a moment when talking about the UK, because I think that was really what got it all going, wasn't it? It was the sense that maybe we are past this kind of accelerating inflation phase of this cycle, and now and there are just on that there are a number of different elements, right? I mean, so we can all see that the economic growth has been slowing, and certainly surprising to see, for example, of economic indicators in across regions, to be honest, but notably in the US, have been there are long-term lows, just as an example. So that's kind of priming the market to an extent. But then the markets have been surprised so often at how persistent inflation has been that I think that they really wanted to see the evidence on the inflation side before going, okay, now we can move on to the next thing. But we've seen a little bit of weakness in commodities, and that's something which as a whole would be a whole lot of other discussion, whether that's something that can really be maintained. Particularly, to be honest with you, in the European context. Nonetheless, we are seeing it. It also seems like there's a bit of an improvement in some of the supply chain questions that have been such a problem on the supply side. And so I think that that's one important part of the answer to your question. People increasingly are believing that we are at peak inflation, and therefore, even if we can, maybe in weeks and months to come, we'll talk about how persistent inflation is still, but it's very different when it's not accelerating but decelerating. And so maybe it's not just going to decelerate fast enough. That's something that we'll have to come back to. It's as I say, an in-depth discussion of its own. But I think that what's happening is that people are now moving on to the next big theme, which is, okay, right, we don't have to worry so much about inflation, it's growth. And the sense that we are staring down a recession is clearly increasing. So, I dare say Jan will come to it at the end of our discussion today. But, it's something which is reasonably openly being discussed as a possibility and a risk by central banks. I think, if you look at surveys of business leaders, it seems to be a base case, to be honest with you. And so, then the question becomes, are central banks really going to deliver all the hikes that we're pricing in at the moment in a recession? And you might have some hard-nosed economists out there that believe that is what they should do, because they'll tell you about sacrifice ratios and things like that. How long are we going to have to run sub-trend growth, higher unemployment, perhaps meaningfully higher unemployment, in order to bring inflation back down? And do central banks really have the guts to put that through? And I think we all suspect that they probably don't. And that's not just it's not just a courage question. It's also, their basic framework is slower growth should mean a slowdown in inflation. And so then it comes down to, okay, so what does caution mean for them? So that I think is a longish answer to your question about what's happening, but it's just happening very, very quickly. And I think that just to finish up on that, the one thing that we did have today, and I was flippant at the beginning of my answer, a little bit flippant, was that the reaction was to the what was a reasonably modest downside surprise on the PMIs, given that the PMIs are pretty uncertain anyway in Europe this morning. And I think that people just feel like this is confirmation that the momentum is very much in this direction, and there was a lot that can be priced out. So that's it.
I guess, well, you've sort of answered this question, and it's sort of a difficult question, I suppose, given how quickly markets are moving and just how volatile they are. And even in normal markets, we know how fickle they can be and how quickly they move from one theme to the next. But I guess given everything that you've said there, you think that this is a kind of go with for the moment. What kind of trades and I guess yield, direction, shape of the curve, etc., are you expecting from here then?
Yeah, I mean, this is the most important question, of course. It's easy to say what's just happened, and regular listeners will know, and readers of our strategy will also, that I've been more on the bearish side for rates for a long time, and so it seems like almost. You might come back at me and say, so what is it about this 50 basis point move that's made you more bullish? But I think I have a lot of sympathy with this sense, and it frustrates me greatly that it's happened so quickly that we haven't really had the opportunity to get ahead of it, because who can get ahead of a market like this, right? It's cleverer people who have more foresight, I suppose, is the answer there. But it's very frustrating. I'm sure that I'm not the only one that feels that frustration. At the moment, I think it is go with. Simple as that. Particularly at the front end. We have been saying for weeks, and again, it's been terrifically frustrating, because we've been repeating that there's been too much priced in for central banks, that we don't recognize the skew of risks in what central banks are pricing at the front ends. Okay, and that we have been reasonably consistent on, and actually really putting quite a lot of emphasis on that in the UK. You have, Imogen. Yeah. So I think that this is that's the first thing to say. I think that it is something that you go with, particularly led by the front end. So the curve shape, I think it is what we're. So yesterday, as in Wednesday, we saw a flattening rally, which I think was it was really very confusing. Today, that's turned into a full-blown steepening rally, which makes an awful lot more sense. And I think that is probably the way that this continues. Why? Partly because this being, if this is the right evaluation of the reaction function for central banks, where more caution means caution on the policy rate, as in not moving too quickly, then that perhaps stokes up inflation and some degree of inflation risks further down. I also think that central banks, particularly this is the case in Europe, I think everywhere, they would much rather not deliver the hikes than risk being flipped back into QE. So so I think that is an important consideration for the curve also. And again, coming back to something that we've spoken about at length in previous podcasts, I think that there's this sort of cross-asset sort of portfolio sort of strategy angle whereby unless you see all of this, supporting stocks to a greater extent, which it may. And I think that there's still longer term questions about the value of long term fixed income. Plus QE's ending. There's a lot more supply that still has to find a home. So there you go. BTPs, I think, should be doing better. So that is, Italy should be doing better than it is right at the moment. But in this kind of volatility, I'm not that surprised. And if we're worried about recession risks, I'm also not surprised that it's lagging a little bit. I'd expect it to catch up when things kind of shake out. But this is actually a relatively minor point to make today.
I was just going to say, I guess there's still a fair amount of uncertainty. We had that monster rally last week with the ad hoc ECB meeting, but there seems to be now we're kind of drilling down a bit more into the details of this kind of OMT 2.0 tool and what that might look like. And there's kind of a few conflicting headlines around what the parameters might be and how powerful it might be and stuff. So that's perhaps holding BTPs back a little bit.
No, exactly. So maybe they just did the correction they needed last week, and now that people are, who knows? Maybe people are just fading that, using the rally to anyway. So we'll come back to that. I think it's now time to come to the UK and reflect this back on you, Imogen. It's been an equally busy week for the UK markets, and we've already mentioned that the UK was really in the driving seat from the get-go yesterday. I just want to give you the opportunity to develop that from your perspective before we move on.
Yeah, for once it felt like the UK was, as you say, the driving force of global fixed income, because it feels like for the last couple of weeks, the UK has just been whipping around with whatever Europe and the US have been doing. So it was nice to be at the forefront of the action for once. It was a volatile start to the week. This was always set up to be a very busy week for the UK. We had a lot of central bank, in the context of the UK, we had a lot of central bank speaks scheduled. A lot of data in the UK and elsewhere. We've had public finance data, we've had the PMIs, we've had inflation, we've got retail sales still to come, consumer confidence still to come. And then we had the long end syndication as well at the beginning of the week. So we started off actually quite weak at the beginning of the week. We had hawkish rhetoric from Man, which is not surprising. We didn't really learn anything new, but we know that, really up until yesterday, this market kind of placed a lot of weight on hawkish rhetoric, and so priced in even more into the front end. We then had the syndication, which was smaller in size, and the allocations caused a little bit of not just a little bit, but a sell-off, particularly at the long end of the curve, with real money and LDI getting significantly less than they usually do in these kind of supply events. But then we had the inflation data come on Wednesday morning, and that was the real turning point. And there wasn't so much surprising, I guess, in the headline figures, but the real story was just this softening in core inflation. And we know that the Bank of England have been vocal about this idea that they can act forcefully if they see persistent inflation. And Pill's reminded us a couple of times now that persistent inflation is not the same as high inflation. And that just that slightly softer print for the last month of inflation, I think, just poured a little bit of cold water on this idea that we might be getting kind of inflation expectations out of control, and we may well see persistent inflation by the end of the year. So we actually have the peak in core inflation now coming in the next couple of months. We think that comes in July at just above 6%. And although it remains a little bit sticky into the end of the year, we do have it coming off by the end of the year and then getting down to about 3% by the end of next year. So that was, as you say, this driving force that actually globally, it seems like both on the growth side and on the inflation side, pressures might be alleviating a little bit. And then, of course, that was followed up today by weaker PMIs in the euro area. Actually, UK PMIs came pretty much as expected and in line with last month, but they'd already had a bigger adjustment last month. So if you remember, the euro area data was a bit more resilient last month. And so there was a bit of catching up to do, I would say, on the European side. But weak PMIs on the European and the US side this afternoon have driven another rally in fixed income across the board. So the UK has fully participated or led the way rather. And I think pretty much everything that you just said about Europe, Giles, we could kind of copy paste into this UK section and just give a little voiceover whenever you say Europe and put UK.
But then we would deprive everyone of your voice in the which of course we know everyone is tuning in for. So the gilt view then. Last week you were turning a little bit more bearish,
less bearish.
less bearish. Yeah, you were losing bearish conviction last time. I guess you weren't necessarily anticipating quite such a rapid turnaround, but who was? How are you feeling about that now?
Yeah, I wish I could say I was, but I think, unfortunately, I'm probably voice recorded on this podcast just saying that our bearish conviction was waning. I think, I can't remember if we said exactly these numbers, but I think at the time we said that we saw 265 as being the kind of top in yields, and anything beyond that looked very stretched. They've rallied, I think, I was checking the chart because I was showing off to Ross. They did hit 265 or just went through, and they've rallied back, as you know, quite significantly from there. I think there's bullish and bearish pressures from here. Pretty much everything you said about Europe, I think, is relevant for the UK as well. I think the data is about to turn. As we said, we expect the core in the peak in core CPI to come in July, and then it trend downwards from there. We think that the GDP data is likely to get weaker into the end of the year, but particularly weak over the next couple of months. We have June as the kind of weakest point in our monthly profile this year. So the data turn is coming, and it's coming pretty soon, we think. We've spoken at length on this podcast and in our written notes, as you said, Giles, that we think the front ends are pricing in much too much. Front end of the UK has priced out about 125 basis point hike now by the end of this year, but that still leaves a significant gap between what we think the Bank of England is signaling and what the market is pricing in. And it just felt like yields had adjusted far enough. If you put in our bank rate forecast, our macroeconomic forecast into our gilt model, they were suggesting that gilt yields should be significantly lower than here. If you look on a kind of PCA analysis basis, gilt yields look cheap, particularly on a cross market versus treasuries. Seasonals are supportive. Gilts tend to do well over the summer months. So there's a fairly long list of reasons, I think, why gilt yields can continue this kind of bullish run, and this kind of global turn in the data, I suppose, is one of the biggest ones. Of course, we can't forget, exactly as you said, supply is still to come. I think if anything, we learned from the syndication this week that the smaller size means there's more long end supply to come down the line. Demand wasn't huge, particularly from those that usually have structural demand for the long end of the UK curve. And is that an indicator of the fact that bonds offer no real hedge value anymore, particularly in these kind of volatile markets? QT is coming, we think. That adds bearish pressures. And although, it's a relatively well-known and probably relatively well-priced in factor that QT is coming, there's still a lot to play for, I suppose, in terms of, scale, how it's operationally designed, although it's priced in and it's a known, what we think is a known fact that it's coming, I can't imagine that the first few operations will get underway, or even the announcement will get underway, without any adjustment in yields or volatility. So there are still reasons to be bearish. The public finance data today suggests further upside risk. I think the actually most interesting point perhaps is what it tells us about interest expense. That's risen to kind of post GFC levels. We'll soon be breaching those levels, which again implies upside supply risk. We have fiscal stimulus announced back in May, and perhaps some more coming next year in a pre-election year. So there are medium-term reasons to still be bearish, and I think that can kind of temper your bullish conviction. But I do think over the coming months, as the data softens, maybe quieter summer months, maybe that's too soon to say. I think that there's reasons to think that gilts can rally further from here. So we've updated our target to look for 215 in gilt yields, although in these markets that isn't very far away. It feels like it could be could be by the close of today, but it's probably about 15-20 basis points from where we are now.
I thought for a moment you're going to suggest that we might get there before we finish recording.
Well, I'm not ruling anything out in these markets. All right, then let's move on to the US. Like I said, we could have started with anyone this week because it has been a super busy week. But Jan, you got the top spot last week, so I demoted you to the bottom this week. I hope you don't mind. Of course, couldn't go a week without more central bank action in the US either. We've had Powell's semi-annual testimony yesterday and today. Have we learned anything new there that might matter for fixed income markets?
Yeah, the US moved a lot too. And if you kind of took a 10-day hiatus and just came back, you probably would have kind of found yourself exactly where you left. Meanwhile, you had 25 basis points intraday moves. But that being said, yeah, it was important. But for those who closely watched the June FOMC meeting, we didn't really learn all that much from Powell's first day in front of the Senate Banking Committee. As we're recording this, he also has he's about to kick off his remarks in front of the House Banking Committee. So this is the second day, but most of the information is already kind of given. If there's new information, it's given the first day. A lot of the focus was around how he understands the hardship that high inflation is causing, and just generally kind of doubling down on their commitment to bringing that inflation back to 2%. But there's a few things there that were a little bit different, I thought. It felt a little bit more political from both sides. From one side, he was kind of getting a little hammered on the idea that they've been telling him he should act faster, and he kind of let inflation come where it is, and they took their time. From the other side, now there's this newly kind of like rising criticism that they might not be able to control things like gas prices or food prices through interest rate hikes. So what they're going to end up causing is just undue economic hardship and kind of increase unemployment at the expense of trying to bring down inflation. So it's in a very difficult spot to be, but he pretty much gave a similar feeling to what to his press conference in June. Last week. So pretty much open to anything, asked about 100 basis points, doesn't exclude anything. But given how forward guidance has become a little less reliable and how much they're going to be data dependent and nimble, I think at this point, anything's on the table. Why even box yourself into a position of 50 or 75? Just say whatever is needed. They will do whatever is needed. But it was, and that being said, it wasn't also a market moving event on that side. So just the message is clear. They're going to do whatever is needed to bring down inflation. That might mean increasing the pace, decreasing the pace. At least it was kind of open, or admitting more openly that a soft landing will be very, very challenging now. And that seems like a decisive shift from the rhetoric almost like a month ago, when a soft-ish landing was very much so their base case.
Now, we've spoken at length about what we think about European and UK yields here after the moves that we've seen in the last couple of days. So it would be a bit remiss of me to not ask you also what you think about US yields. You guys were actually kind of quicker, I suppose, on this turning point than us. You've been talking about kind of peak hawkishness and growth risks. Well, I don't know, you're going to correct me now, but it feels like a couple of months ago now even, and you kind of pared back on that given the market volatility. So how are you feeling about the outlook for US yields from here?
Yeah, I mean, I think if anything, our view that the markets are going to focus more and more on the recessionary risks should have increased, because think about the sequence of events. We had a blackout period where we're about to head into the FOMC meeting with the wide conviction that you're going to get a 50 basis point hike. Then kind of like a statement leaks out or is given to the journal that they're actually going to go 75, catching markets off guard, giving giving a feeling of panic, or at least feeling cornered, the need to do more. And then the data hasn't changed. If anything, it's looking slightly weaker. The only thing we learn is that the Fed is willing to increase their pace, which to me means they're going to keep going until either something breaks or, we somehow miraculously achieve this more moderate, kind of like more controlled landing, which could happen, of course, through through significant lower commodity prices. But like Giles said, that's a completely different topic that we can spend lots of time on. But the whole point in our view is that unlike Europe, I guess, a lot of the US inflation is heavily domestically driven. So the Fed is not going to have the flexibility to really pull back that much. Yeah, they might stop and say, instead of going 75 basis points, go 50 or 25, but they're going to go well above neutral in a very, very short period of time. So that sort of, that sets like a low bar of when they can stop and how like the least amount of distance they can go. And all that to me means that you should just not realistically see real yields going up in like the 10-year point the way they did. And with kind of inflation expectations are centered around 2.5%. Yeah, that sounds about right to me. But just assuming that the Fed's going to go as fast as they will, and that should mean kind of like higher intermediate yields, it's just not the right idea to me, given what they contain. So long story short, I mean, we're kind of almost back to where we were before the FOMC meeting, and yields have been rallying a lot. So it's just the volatility kind of made it untenable to keep doubling down, and you want to see the trend switching, because in all fairness, trend following strategies have been one of the most successful strategies this year, and this might be one of those cases where getting ahead of expectations of a recession might not be the right move, but rather seeing the data topple or start turning and then jump on that wagon. So being the first might not pay off, because it really, really can go against you, while once the trend starts, I think it will continue.
All right. Thank you, Jan. Thank you, Giles. Well, I guess we'll be back here same time next week to see if this really is a trend or if markets are focused on something else already by next week. Thanks, listeners, for joining. And just a reminder, if you liked today's episode, don't forget to hit the like button and please subscribe so you can get the latest episodes as soon as they're available. See you next week.